Hey everyone. My name's Thomas. I'm the founder of FE International. We're a technology-focused investment bank. So we work with founders and business owners who ultimately want to sell their company or potentially looking to buy a business as well. So today, over the years, we've closed over 1,500 acquisitions, which is over $50 billion in total transaction volume. What I'm going to be talking about today is all of the data points we've seen from those deals and what makes a business worth more. You can speak to 1,000 different buyers, you can speak to 1,000 different investors. They will all give you a completely different answer to that question. So we've gathered the data and got the kind of real answers on what buyers are looking for and what correlates with a higher valuation. So hopefully by the end of the presentation, even if you're not thinking about selling your business today, you'll get a better idea of what value drivers there are to make your business worth more in the long run. And for every single person in this room, even if you're not thinking about selling a business today, the vast majority of people, if you're building a company, maybe an exit is something you're thinking about in 5 years, 10 years, 20 years' time. It doesn't matter what that timeline is. But every single person in this room, if you're a founder of a business, at some stage you have to exit it. The best way to do that is with a successful sale. You don't want to have to shut it down, give it away, or run it to zero. So selling the business is the best thing you can do. So just for some context, particularly if you've been following the VC world and the SaaS industry for the last couple of years, there's been a lot of negative press around deals not happening, there not being much capital out there, the industry being a little bit slow. But the reality is that's really not true. If we look at the data over the last 20 years, this is available private equity capital in the US alone. You can see as of pretty much today, there's nearly $4 trillion in dry powder. And the nature of private equity funds, they raise money from private investors. They have to deploy that capital. If they don't invest it, it gets returned back to their investors. So they're incentivized to spend that. Many of those US-based private equity firms are acquiring businesses outright. And many of those are doing it in the SaaS space. And you can see there's been a vast increase over the last 20 years. We had less than $1 trillion in 2003. Today, there's nearly $4 trillion. So it's been a big increase. That's consistently going up. So if you're ever wondering like how many companies are able to exit, how much demand is there out there from acquirers, every single person at SaaStock could sell their business tomorrow, and I could do this presentation in a week, and the number would barely decrease. There's so much capital out there, it's only ever increasing, and we don't see a world where that's going to change. So if we look again, talking about doomsday data, a lot of people think that deals aren't happening at the moment. People will often look at TechCrunch, the big publications, what are they talking about? What is Wall Street talking about? So Goldman Sachs, JP Morgan, the big investment banks that you've all heard about. If you look between 2021 and 2022, they saw a 38% decrease in M&A deal volume. We saw a 51% increase in deal volume. And a big part of that is the average transaction we work on is in the 1 to 100 million valuation range and above that as well. Private equity firms are coming further and further down market to acquire smaller and smaller businesses. 10 years ago, private equity firms would not look at anything below 100 million in valuation. Today, they're looking at businesses worth 10 million, 20 million, 50 million. So part of the reason our volume is going up and Wall Street is going down is the private equity firms that have the dry powder, need to deploy that capital, are buying smaller businesses than they were before. So for many people in this room, there's still a lot of opportunity. You don't have to build a business to 100 million revenue to be able to sell it. There's demand at basically every single level. So getting into some of the data, like what actually makes a business worth more, like I said, over 1,500 transactions we've worked on and closed. We've plotted all of those data points to see what correlates. So if you have a SaaS business, the higher your net dollar retention, so essentially the better your revenue churn is, the higher your valuation will be. And you can see there's a pretty significant increase in valuation if you can get your net dollar retention above 100%. So generally, the best way to do that is with kind of upgrades, particularly of a B2B product, sell them more licenses, sell them more usage, or whatever that might be. But companies, once they get over that 100% level, if you can get there, are worth more. And this, just for reference, this is deals of all sizes. So take it with a little bit of a pinch of salt if you have a smaller business or a larger business. This is really just for general correlation. And we look at the next metric, which affects valuation, is the higher your annual revenue growth is, the higher your valuation will be. And that's just on a yearly basis. So businesses growing at 40% or more per year, top line, sell for significantly higher multiples than businesses that are growing at less than 20% a year. Now, that doesn't mean if your business is growing at 0% or 5% or 10%, your business can't be sold. But probably the most common question I get is, what makes a business worth more? And that revenue growth rate is extremely important. If we look at the data across all of our transactions, essentially the faster you're growing, the more your business is worth. And then if we move on to the next slide, this is also relevant over a multi-year period. So 1 year of growth is great, but if you can show consistent growth for at least 2 years or more, then you get even more of a premium multiple. Acquirers ultimately want to buy a business which is consistently growing, not a business that had one good year. Particularly everyone went through COVID. A lot of businesses had a fantastic year during COVID and then fell back down again. So the buyers who were paying a premium for businesses that had one good year ended up with not particularly good deals. So buyers are not stupid, and they know that consistent growth shows true value. Just 1 year is definitely not a bad thing, but if you can consistently grow, your business is going to be worth more. The next metric that's important, it's not all about growth, it's all about how efficiently you spend your marketing dollars. So essentially what the data shows, the more effectively you are spending marketing dollars, so the technical term for that is sales efficiency, the more your business is worth. So it's not all about growth at all costs, it's also about growing efficiently. So gone are the days, and we're talking about Wall Street deals where you can just raise a lot of money, throw it into growth, you don't have to worry about profitability. Buyers care about how efficient you are with that spend and how that translates into growth. So you can't just look at these slides on an individual basis. You can't say, if my business is growing, nothing else matters and it's going to be worth more. You have to also be spending efficiently to do that. We're obviously all at a SaaS conference today, so I'm assuming most people in this room are building either a software business or a service-based business. We describe ourselves as a technology M&A firm, so we don't just work with SaaS companies. We also work with e-commerce businesses, so selling physical products, digital media, which is things like podcasts, blogs, YouTube channels, anything that's producing content as part of their business model, and anything in between. So just from the fact you're building a SaaS company means your business is going to be worth almost double some of the other business models we see. So compared to e-commerce companies, nearly triple. Compared to digital media businesses, nearly double. And this is, again, just a like-for-like comparison. There's obviously lots of variables that go into valuation. But ultimately, if you're building a business in the SaaS space and you're at SaaStock, you're in the right industry compared to many of the other business models you could have been working on. I already mentioned a little bit about revenue growth being important, but also your profitability is important. I think a lot of people at SaaS events, you might read VC blogs, will talk about the rule of 40. So we considered, is the rule of 40 even important? Does it matter? Does it translate to a higher valuation? And the answer is actually yes. So from our data, and you see with the rule of 40, just to keep it super simple, if you're in the gray shaded area to the right, their businesses meet the rule of 40. To the left, they do not. And you can see there's a correlation with higher multiples, so a higher valuation essentially for equivalent businesses if they are meeting the rule of 40. So in super simple terms, that's a combination of your revenue growth rate plus your EBITDA margin, add the two together. So if you're growing at 20% year on year and you have a 20% EBITDA margin, you're at 40. So you just about get into that range. So again, it doesn't mean you have to be meeting the rule of 40 to sell your business, but there is strong correlation between companies that do meet it and companies that are selling for the highest multiples. So again, you can't just look at all of the slides on an individual basis, but if you combine them together, it's definitely important. It's very easy to discount and assume it doesn't matter, but the data shows quite strongly that if you're meeting that, then your business is worth more. It's all very well talking about data. I've obviously amalgamated 1,500 transactions. You can't really tell a huge amount from like a specific deal. So I'm just going to talk about the reality of a recent transaction we closed in the 8-figure range and what that business looked like behind the scenes, what it sold for. The only thing I can't tell you is the actual name of the business. So the business we represented, it was growing 43% year on year. So going back to one of the earlier slides, over that 40% level, we already know that businesses growing over 40% sell for more than businesses that are growing less than that level. It had 110% net dollar retention. And again, we know from the earlier data that 110% revenue retention is better than a business that has, say, 90%. So it's a very important metric. It had 8 figures ARR, so it was over 10 million in annual revenue. Generally, and this is not in the slides, but there's correlation between the size of your business and what it will sell for. A business at 10 million ARR is generally going to trade for more than a business that's at 1 million ARR. They also had 17% customer churn. So that might sound strange given they had high net dollar retention, but what they were doing in their case is they realized that net dollar retention was an important metric, and they realized they got the higher dollar retention from their bigger customers, so the cohorts that would spend the most. So they put all of their resource into focusing on those bigger customers, getting them to spend more, and they essentially let the smaller businesses that they knew would not expand their revenue even, they let them churn. So customer churn is not necessarily a problem if you're expanding the bigger accounts. So don't be afraid to move up market and lose the lower end. You can churn those customers as long as you're getting expansion elsewhere. So that's not a problem. And then there's a little bit more about the business itself. There's lots of different ways to build a company. We've met lots of businesses over the last couple of days. We've met businesses with 4 founders, 3 founders, 2 founders, solo founder. We've seen in our data 0 correlation between the number of founders and your valuation. It doesn't matter. It doesn't affect valuation at all. This particular company just had 1 solo founder. They were profitable. It's not essential for an exit, but it certainly helps if you're profitable. And they had a team of 75 who were mostly being run remotely. Also, there's no correlation. You notice it's not in the slides. There's no correlation between having an office and running a team remotely. Businesses all operate in a different way. At FE International, our entire team is in an office. I'm not particularly good at running a remote team. I don't think you can run a good investment bank remotely. Can you run a SaaS business remotely? Many of you in this room probably do. So it really doesn't matter if you have an office or not. In this particular business, they focused on product-led growth rather than sales-led growth. And that was important because it helped keep their marketing spend very efficient. So they didn't need to spend a huge amount on sales and a huge amount on marketing to keep growing their business. That doesn't necessarily mean you can't build a fantastic business with sales-led growth. And again, there's no particular correlation between the two and valuation, but it definitely meant in this case, it helped them be profitable, helped them be lean, and helped them attract those customers that would spend more in a relatively self-service way. They didn't need salespeople calling their customers to get them to spend more over time. Back to my very first slide, everyone at some stage has to exit their business. There's no right or wrong time to sell your company. It's ultimately a very personal decision. There's not as soon as you hit 10 million, 20 million, 50 million, 100 million valuation that you have to sell. It's a personal discussion. Generally, if there's multiple founders between founders, other stakeholders, husband, wife, kids, other relatives, people in your personal life that matter. It doesn't really come down to a formula on an Excel sheet. We can tell you what your business is worth, but we can't force you to sell today, nor do we. So part of our job is giving you an accurate valuation to give you an idea of what your business is worth, but people have to decide to sell for themselves. And a lot of people say, well, why would I ever sell my business if it's profitable, growing, they're growing at 42%, running remotely, it's profitable, everything's going in the right direction? Ultimately, with the case of the founder we worked with here, he's decided that he wanted to sell the business to someone who could take the business to the next level. In his mind, he thought he had taken the business as far as he could take it and didn't want to go any further and had reached a valuation level where he ultimately would never have to work again if he exited, which quite honestly is a big reason why people decide to sell. They reach a level where if they sell, they never have to work again. And I know it doesn't really sound particularly inspiring or anything like that, but ultimately it is a good reason to sell. So lots of people we work with will do that, and then they'll come back, launch another business, they'll raise some money, they'll bootstrap, and they'll go do it again. Almost nobody we work with only has one exit in them. Everyone can build another business. So just a little bit about the structure of this deal. Like, we definitely hear a lot of misinformation about deal structures and what happens in M&A. A lot of people assume that when you sell your business, you don't get a huge amount of cash. So you sell your business for $100 million, but you get $1 million in cash, and then you get 99 million paid on some unlikely terms that you're never going to receive, or you receive stock in a company that's ultimately worthless. We focus on getting deals which are primarily focused on cash. That doesn't mean 100% of the time you're going to get all your money in cash, but that's what a lot of clients we work with want. In this particular deal, there was 11 competing qualified offers. That's very good. I've definitely cherry-picked a good deal in this case, but we look to get multiple offers so you can negotiate and ultimately get the best deal possible and the best terms. It's not always about getting the highest dollar value. It's also about getting the best terms. So in this case, talking about terms, 90% of the deal was paid cash up front. So even if everything went wrong post-sale, they still have 90% of the cash, which is important. 10% of the deal was paid after 12 months based on what in the US you call reps and warranties, which is essentially a legal clause that if you breach any kind of terms in your initial purchase agreement, that 10% of the transaction might not get paid out. And that's common in basically any deal if you have a US acquirer. This particular founder was actually based in Australia. The acquirer is in the US. There's also, you'll notice, no correlation between geography and valuation. Buyers in the SaaS industry, at least, don't care where you're based. It doesn't matter where you are. You can be anywhere in Europe, anywhere in Asia, anywhere in the US. There's buyers for your business. There's a very short transition period. The client didn't want to work for a very long time. He had a 6-month handover period. So he was out. He didn't have to take an employment agreement. Many people think you have to do a 5-year employment deal to sell your business. Not true. And ultimately sold to a private equity firm. There's lots of different acquirers out there. But as we saw from the earlier slide, there's $4 trillion in dry powder at the moment. Chances are at least one of the bidders for your business will be a private equity firm. And ultimately, in their case, they sold for $75 million. So solo founder, no outside funding, majority in cash. You sell for $75 million. You have a lot of life options going forward. So super quickly, we've got 30 seconds left. So if you're just going to remember 5 things, work on improving churn, and that's specifically revenue churn. Customer churn is less important. Keep your business growing. The rule of 40 does matter when it comes to valuation. There's always dry powder. There's never going to be a shortage of capital in the US or in the SaaS industry particularly. And have an understanding of what your business is worth. So I have nothing to sell anyone today, but if you want a free valuation for your business, we're happy to take a look, tell you what it's worth, scan the QR code there, or come grab me afterwards. We've also got a booth over in the corner of the main hall. Understand what your business is worth today. it's probably not worth the number you want to sell for. Maybe your business is worth 10 million today. You want to get to a 50 million valuation, but it's important to understand where you're at. But pretty much out of time, so thanks everyone for your time, and enjoy the rest of the event.